Hey, it's John Long with Ardent Real Estate Group, and today we are here with Scott Hupp with S&S Mortgage, and we're going to talk about what's the difference between the advertised rates that you may see online or something you get in the mail, and then when you actually apply to get pre-qualified after you submit your financial paperwork, your credit score, why it's different quotes than maybe what you see online or in the mail. So stay tuned. So hey everybody, I'm John Long. This is Scott Hupp with S&S Mortgage, and so we're going to talk today about how when you're shopping to go get a loan or you're educating yourself on mortgages, your interest rates, you'll maybe go online to some real estate websites and you'll see interest rate quotes anywhere from, or advertised rates anywhere from 4.5% all the way up above 5%. Some are requiring fees of $1,500, some have no fees. Some require points, some have no points. And we're going to talk a little bit about how there's a difference between what's advertised and the things that are involved to determine what your interest rate will be. So Scott, this is Scott, and I'll let him introduce himself and then he'll explain a little bit about that.
Well, thank you for having me, Jonathan. And my name is Scott Hupp with S&S Mortgage. I've been in the business of lending for over 35 years now. And I teach a class at Cerritos College on real estate finance. And that's a great question because it comes up all the time. And what I tell my students is because of the compliance issues nowadays and because of things that have gone on with the real estate crash and the mortgage problems, it is almost impossible for a borrower just to call up or go online and get an actual quote for an interest rate, okay? Which makes it very, very unfortunate for the people trying to find rates. So if you go online and you see an interest rate online and you think that's what you're gonna get, it's typically not anywhere close to the rate that they're gonna have. They want you to call. I don't wanna say it's deceiving sometimes, but the actual interest rate depends on the amount of down payment, the credit score, the type of property, impounds or no impounds, whether or not you're going to lock the loan, how long you're going to lock the loan, and a myriad of other things. So as you can see, it's almost impossible for you to say, what's my rate today, and have them quote you. So a lot of times they'll have you fill out something online. A lot of times they'll tell you we can't really even lock your loan in until you're fully approved. So the borrower thinks that they're getting a rate of 4 3/4, let's just say. And when they finally lock him in, it's 5.125, and by then it's too late.
Yeah.
So it's unfortunate from the standpoint of being able to shop online. If someone calls me, I can quickly determine what the rate's going to be based on 3 or 4 questions. But that doesn't happen online and on TV and on the radio.
One of the things that Scott brought up, is there's just so many factors that are involved in the rate that you're going to get. And one of the big things that I see, I even have clients today that are in escrow, when they started off getting quotes, they didn't take in consideration that they bought a condo and there's a different rate for a condo versus a single family home. So, explain a little bit about some of that criteria and how, it makes a difference. I mean, even the loan amount, if it's above certain limits, you're going to have different rates.
Right. And again, all good points. And when we talk to people that have done some research online, they'll come in and they'll say, well, I went to this website, or I got this call, or I see this in the newspaper, something like that, and this is the rate that I see. After talking to them for a few minutes about the loan amount, the down payment, the property type, the credit scores, you say, okay, this is where you fit in as far as the rates go. There is no magic money, okay? It doesn't exist. I've been looking for 35 years and it's not out there.
When he finds it, he'll let me know.
That's right.
Yeah.
But what I'll tell you is that a lot of stuff that's online, a lot of stuff that you see on TV and even hear on the radio, the guy that does the no-brainer stuff, is designed to get the phone to ring. All they want you to do is call them. They can't maybe get you that interest rate for what they say is on their published piece of paper or on the website, but they want you to call. Good example, Quicken has the Rocket Mortgage app, okay, and everybody's kind of seen that. Well, of the people that try to apply for Rocket Mortgage, which is a loan approval in like 30 seconds, 7% of people that apply can even get approved with that. But it's a brilliant marketing thing because then you have to call them.
Yeah.
So my point is that there's a lot of deceiving and deceptive and very unclear interest rates and loan programs out there. So you really need to call someone and develop a relationship and figure out what's going on.
Yeah, I think this morning I got a thing in the mail the other day that quoted me 3.98% to refinance my mortgage, and I call Scott. I'm like, what is this? It doesn't. I'm looking for the disclosure, and sometimes it's hard to find exactly what those terms are, and there's just so many variables and what it could be. I mean, they're definitely showing you the shiny rate. I mean, if you're perfect and you meet all the boxes, which is near impossible. It's a possibility you can get that because obviously, they advertise it. So some people have to qualify for that rate. But, there's just so many variables. And so as a realtor who's working with buyers and sellers and they're looking to purchase something, sometimes it's hard for us to explain to a buyer exactly how that works. We don't have a rate sheet in front of us. We can't go through all those details. And that's where, for me, I feel like I'm pretty savvy when it comes to financing for a realtor. But even with that, there's just so many details and that number can change too. What you're quoted yesterday may not necessarily be the same, next week. So that's why refer it over to a lender and let them explain to the buyers, why the rate is where it's at. And for some buyers, for a good example is you got some buyers that may want to do upfront mortgage insurance. They don't have enough money down. They want to do upfront mortgage insurance, which is going to cause a higher rate. But it's in that client's best interest to make the decision whether that is the way they want to go. And the lender will give them those options. That's one of the things I like about Scott is when he's working with our clients, he'll give them the options. You can have this rate, with, this amount down, or, you can have these options, and then they get to pick and choose.
It's a good point. As an example, I always use in my class sometimes, and what will happen is you'll get a quote for like a very low interest rate, somewhere that's a half point or sometimes a full point below what the average 30-year rate is that you're seeing. You find out it's like a 3-year ARM, adjustable. Now what they do is they tout it as a 30-year mortgage, which it is. They don't say it's a 30-year fixed because it's not, but they say it's a 30-year mortgage. Mm-hmm. And then they quote it, and of course once you call and find out it's a 3-year fixed, then I didn't want the 3-year fixed, I want a 30-year fixed. Then you figure out the rate's about what it was or higher than what you're getting from someplace else, but they've already got your application, they've already got your information, yep, and away you go. So misleading, I think so, but again, that goes back to where I think that with you and your people, you're very savvy as far as what goes on with the mortgage. If someone's giving someone a rate that there's no way they can get, and the bells and whistles need to go off a little bit, and you go, hey, we need to call and talk about this with somebody because that's not reality.
It's usually, if it's too good to be true, it probably is. There's something there. There's something that wasn't explained correctly. In the loan or what the package deal is for that loan. Exactly.
So it'll be interesting to see how it transgresses going forward, because again, the whole point of this thing was to make this all more transparent for the buyer, which is in concept a very good thing. But the problem is then it's made it so difficult for the borrower to even be able to shop, mm-hmm, as far as what's going on in the loan that they're going to get. The other thing we see a lot is people say, okay, well, yeah, you're pre-approved for a certain amount of money, and then a month later they say, well, you don't qualify.
Yeah.
And a lot of these larger lenders, of course, don't have the expertise at the point of sale to be able to tell if someone can qualify for a loan. So they have to be cognizant of that too.
Yeah. And that brings up another good point. I mean, there's some times where we have clients that are self-employed versus clients that are on W-2s. They get paid a salary or hourly or whatever, and that will take into effect, what they're going to qualify for. Self-employed people usually have write-offs, and some banks, some underwriters will allow those write-offs, and some won't. And you got to determine, what that's actually going to look like. So when you have an experienced lender that doesn't just push you an application, say fill that out, yeah, we can get you a loan, and they really know the details of underwriting, like Scott does, that really helps us as realtors, so that way we don't set expectations too high for our clients, and then now we're writing up the offer, we get the offer accepted, everybody's excited, and then all of a sudden we come back, we have a problem with underwriting. they're actually not going to allow all those write-offs. So you actually don't qualify for this house anymore. But, the lender may have not known, as much as they should have about the underwriting process. And that's where an experienced lender, comes in handy.
Yeah, it's a team effort, and I think that everybody has to be involved. I think that the average homeowner, we get people that are very sophisticated, very educated people, but maybe they've never bought a home before, or maybe the last house they bought was 25 years ago. So they don't understand the matrix and what goes into the lending nowadays, and so what worked 20 years ago doesn't work anymore. So we need, and the realtors need to be able to tell very, very quickly whether or not someone's going to be able to get the financing that they're trying to get, or whether there's going to be an issue. So that's, again, some of the things that we do.
Yeah, when I first started in real estate, I think we've known each other for 10 years now. And so when I first started in real estate, Scott was my mortgage teacher, and he pretty much showed me the basic things to talk about with the client. What's your gross income, how much debt do you have, what's your credit card payments, your car payments, things like that, to kind of quickly determine, roughly what somebody's going to qualify, or, is this even a possibility for the house that maybe we're doing an open house on. But even with that, there's sometimes, I'm having a conversation with a client and just some red flags go off, self-employed, but I had a bankruptcy X amount of years ago, so it's like, okay, well, that changes everything, and now you got to go check to see what lenders are available to give a loan to that person based off of maybe how long ago it's been since that bankruptcy. There's just so many variables in lending, and it's just not a straight click button pushing and there you go, you got your mortgage and your interest rate, and it's you're all done. It can be pretty complex. So, that's definitely where things come in handy with somebody like Scott, who's very experienced and has been in this business for, I think, longer than I've been alive.
35 years. Yeah, it's definitely a team effort, and I think that that's why we have to be able to work together with the client and get to the point to where they're quickly knowledgeable about what the financing is, what they can get, and then what their payments and rates are going to be.
One thing I wanted to talk about briefly when we were talking about the rates, and you get all these different quotes from, it seems like every lender quotes a different rate. It seems like, but the big question is, like, where does the money come from? Everybody's giving you money at different costs, but yet they're all getting it from where? And who sets the rules and things like that? Can you explain a little bit about that?
Yeah, it's mainly the secondary money market. So there's very few direct lenders anymore. The direct lenders are the big banks and then some credit unions and things like that. Everybody else gets their money from the secondary money market. So they make mortgages that adhere to certain guidelines, Fannie Mae, Freddie Mac, FHA, VA, so they're insurable. And then once those loans are made, they're sold on the secondary money market. So it's a very sophisticated analog about how much money can be made, what the profit margins are and stuff like that. And everybody knows where everybody's rates are. So the best rates are going to be, very close to where everybody is. There are some lenders that are a little bit higher because they do non-QM loans. But that's why I go back to saying there's no magic money. So once those loans are made and packaged together, they are sold on the secondary money market, usually in bundles of millions of dollars, 25, 50, $100 million, whatever it's going to be. Then that money comes back down to the lender so they can make more money. So the money's always going around. Mm-hmm. That's why the rates don't go up and stay up as the money gets more scarce. The money's always turning around, so there's always money to lend.
So I guess a good point to that would probably be, if most of these lenders are getting their money from the same place, they're probably all paying the same cost on that money. So how could you have one lender that's quoting you this and another lender quoting you that? There has to be something there. So,
well, what they do is the ways lenders make money is when they sell the loans, of course. But the other way they can do it is at the point of sale, they can pad their rate sheet. In other words, if you have a big office with brick and mortar, lots of overhead, lots of sales managers, things like that, you have to make more money per loan than an outfit maybe that's a little bit skinnier, leaner that runs. So what they'll do is, let's say we can get your rate today at 4 3/4 at 0 points. Mm-hmm. Well, they'll offer 4 3/4 at half a point or 1 point, because they need to make more money on that loan to pay the overheads. So the source of the money is the same. It's just that who on the street, when at the point of sale, what those people want to make as far as income goes, that's where the discrepancy comes. So they know they can't sell their interest rate if it looks higher than anybody else's. So they're gonna try to get you to call by offering you some lower rate, maybe with a higher APR, meaning you're gonna pay points to get you to call, and then they'll try to work you into some kind of a loan program that works for them.
And on that note, and actually I'm glad he brought that up, because another thing that I want to address with buyers, and this was a big thing back in short sale days, bank-owned REO properties, when that's all we were selling, you get so many people that had the mindset of go with a direct lender, go with a direct lender. And honestly, sometimes we get in more trouble with a direct lender, because if it doesn't fit in that box, that loan, and we have a problem in escrow, the whole deal falls apart, and we got to go find somebody else that can do the loan. So Scott, explain, for some people that they've heard of the word, the term direct lender versus a broker. So talk about those two, and what's the difference?
There's basically three kinds of lenders. There are direct lenders, there's mortgage bankers, and mortgage brokers. And the direct lenders are the big banks, B of A, Citi, and Chase. A lot of them have gone away now because of the issues that happened in the bad times. World Savings is gone, Washington Mutual's gone, Countrywide's gone, because of the practices that they did, which was disparaging and very bad for the clients in the real estate industry. So the bigger banks now have people at the offices that are trained the way the bank wants them to be trained. And typically you'll have a list of things that the loan officer is supposed to get from the borrower: W-2s, pay stubs, tax returns, bank statements, whatever it's going to be. And they can't move this package to the next level, which is processing, until they get everything on the list. Now, a lot of times that person at the direct lender doesn't have the expertise at the point of sale to know whether you can even qualify. They might know the credit score is going to work, or maybe, okay, the guy's got enough money in the bank. But if you get somebody with some complex tax returns, self-employed, they don't know. So you spend a week getting the stuff to the guy. He then sends it over to the processing department at the direct lender, and then from there goes to an underwriter. So it can be a week or two sometimes before they come back and they say, well, this person doesn't qualify. And of course, by then everybody's got moving vans going, everybody's packed up, and it's a big mess, as you as a realtor know.
Yep.
So the mortgage bankers are typically people that we work with. We're a mortgage broker. We have access to a wide myriad of lenders, from direct lenders to mortgage bankers. Some people are good with government loans, FHA, VA. Some are good with adjustable. Some are good with fixed rates. It just depends on who we choose. So the mortgage bankers then rely on us to give them loans, because they typically don't have much in the way of brick and mortar. So when we do all the work for them, we process the loan, we get all the information together, we interview the clients. We then send it to the mortgage banker, and then they underwrite it, draw the docs, and fund it. So there's very little money out of their pocket to do it. So it's a lot quicker, less cumbersome process, I guess, from our standpoint. We can tell within 20 minutes if you can qualify for a loan or not, because we know if you got the money, we know if the income's there, and we know how the credit is. So that's basically all you need to know. But it gets complicated with regards to tax returns and other things that go along.
Of course, yeah. And before we go, I do want to talk about one more thing, like the future of where rates are going. It's like where they're at now. I don't know if we can we talk about like where rates are at next year? Or do you have to like disclaimer?
No.
Okay.
Rates are between 4.5% and 5% right now. Again, depending on what credit scores and type of property and things like that. People get confused sometimes. They think as the feds are raising the federal funds rate, when they say the feds are raising rates, they think, oh my God, rates are going up. Mm-hmm. That's not the case. The Federal Reserve raises short-term interest rates, which affects car loans, credit cards, lines of credit, and other short-term type rates. What dictates long-term interest rates basically is inflation. If inflation starts to creep up, then the stock market and the bond market know that that's going to be an issue, because obviously prices are going to get out of whack, and that's when rates start to go up to try to counteract that. So long term, as long as nothing crazy happens, like begin a war with somebody or a huge stock market crash, everybody foresees the rates being somewhere between 4.5% and 5.25% through 2019. Okay. Now the economy is booming along right now. I can remember interest rates in the 10, 12, 15% range. No one sees that. Everybody is super sensitive to a rate that's it goes up from 4.5 to 4.75.
Yeah, 4.75 to 5%, and things quiet down for a little
Exactly.
bit.
Historically, again, I've been doing this for over 35 years. Historically, anything around 5% or under is a fantastic rate.
Oh yeah, yeah.
Okay. So again, you just have to put it in perspective. So the long-term outlook for interest rates is to stay fairly low. By that meaning, somewhere around the 5% range. The administration does not want higher interest rates because they know that if you start to have an impact on the housing industry, think of all the people that are employed in the housing industry. I counted up one time, there's over 65 people involved in a normal real estate transaction.
Yeah.
Okay, it's not just the buyers and sellers and the agents, it's appraisers, termite people, credit reporting people, processors, doctor, the list goes on and on and on.
Contractors, you name it. Yeah.
So you start to have a problem with the real estate industry, and of course people start laying people off, and that causes unemployment. So we think the housing market is probably going to remain strong for the next 3 to 5 to 7 years, something like that.
Well, hey, I hope you found what we just talked about today to be useful. Now that when you're going and shopping online, you're looking at all those rates, you'll have a little bit more information of, where those are coming from. And, when you're talking to a lender, you'll know why, you saw one rate online and you're being quoted a different rate. If you have any questions, please comment below. Myself or even Scott can, answer any questions that you have. And hopefully we'll see you next time. Hey everyone, it's John Long with Ardent Real Estate Group, and if you're thinking about making a move, either buying or selling a home, then click on the link below to learn more about what we do.